Good evening, everyone. Dan Bird here with the Daily Scan for Tuesday, March 25th. So last week I talked about um, options expiration and max pain, and I said max pain should be positive, meaning the market probably would go up, which it did last week. And I also said that that usually lasts into Monday and Tuesday of the next week, which is today, and so far it has. So the big question now is, will it continue? So for today, because today is Tuesday, I will be doing a technical Tuesday. And today did have a request to cover covered calls or to talk about covered calls and explain what they are, which I will do. There are lots of ways to do options. And for folks that are a little nervous or don't really understand options very well, covered calls is probably the safest way to learn options and kind of get your feet wet with them. Years ago, when IRAs wouldn't let you trade options, the only one that they would let you trade is covered calls because they're very safe, which I'll show you in a minute. There's certainly downsides as well. As always, I'm not a financial advisor, so anything I say is for educational purposes only, and I'm not making any recommendations to buy or sell anything. So before I jump into covered calls, let's take a look at the market and see what happened today. We had another nice little gain. The market bias chart moved up slightly today, and it's getting close to really taking off if the market keeps going higher. But no guarantee of that, of course. So we'll see what happens. You notice that the red light is still red, or the lights here are still red. That's getting close to changing to at least an orange color soon. So we'll see. Let's take a look at the S&P first, and I'll show you what I mean. So here's the S&P. You can see today we got a little bit movement, very slight movement, but it ended with a spinning top doji, which is indecision. And interesting, it happens on Tuesday. Like I said last week, the max pain usually carries to Tuesday, but now we'll have to see if it will continue. And there's no guarantee that that will happen. In fact, there was lower volume today than yesterday too. So we'll see. Is that it? Is that the end of the rally? The rally made it above the 21 and the 200-day. And the 50-day really is the next level to shoot for. And I said 58.50 was a line in the sand. It was a line in the sand on the way down, and it's a line in the sand on the way up. So 58.50 is right there, right exactly there, right at the top of the one-day ATR range, the Keltner channel. So this green area here is the distance that this stock, or in this case, the S&P, travels, usually on average, travels in one day. So that's the 1x ATR right at 58.50. When it gets to the blue area, then that's 2 times the average range. And when it gets to the line up here, you see down here is 3 times. So it could potentially get up to the 50-day and then the outer band of the 2x. And then we'll see. But, you know, this could be it as well. Could start to go back down tomorrow. We shall see. So let's look at the NASDAQ 100. And we'll see the same thing probably. NASDAQ 100 actually had a better day than the S&P. So that's not indecision on the NASDAQ 100. It's actually ended at the high of the day and right at the 200-day moving average. So that looks like it might still have enough momentum to push higher. You can see the momentum is starting to move up as well. Still not above zero. So technically, we're still in a downtrend, and the volume was lower today too. How about the Bitcoin chart? Let's take a look at Bitcoin and see what it did. It has a spinning top doji as well, so indecision. Went up slightly today, 87,800. It's where it is now. You can see down here, MicroStrategy continues to move higher. Along with the with Bitcoin, Bitcoin is right below its 50-day moving average and right at the outer bands of the 1x. So potentially it could still keep going, but it looks like it's taking a pause. Everything looks like it's kind of taking a pause right now. Big major, in fact, it's just moving positive. Major a squeeze up here on Bitcoin. And it is right at the zero line. In fact, on the squeeze chart, the momentum just went blue. So it just went above zero. So momentum is starting to improve or accelerate. And that might imply that the squeeze might trigger to the upside, sending it much higher. We shall see. Bitcoin is today is very correlated with the NASDAQ 100. So if either one of them keep going higher, then the other one probably will as well. So that would be good news, actually. All right, let's take a look at, I want to look at even though the market didn't move a lot today, we can take a look at the VIX. And the VIX actually continues to go lower. In fact, it's 1715. It's sitting right above the 17 level. Below that is where bulls are in control, but it continued to go lower today. Even though the market itself didn't really do that much, the VIX actually continues to head lower. So that's actually positive. We'll see if that follows through for the rest of the week or not. If we look at the 10-minute chart, see what happened today. You can see the market basically went sideways. So this is today's open right here. This is Monday, the vertical blue line. Here's Monday's open. It's horizontal. So Monday opened higher than last Monday. That's good. Went sideways and then actually accelerated at the close. Now the last 10 minutes really don't mean much, but it actually started moving up 30 minutes before the close. So that's actually positive. That might follow through tomorrow then. Technology was higher, financials, discretionary, so all the aggressive sectors look pretty good. Communication services, industrials was down, but most of the aggressive looked pretty good. However, on the defensive, and actually this is what we want if we're going to get a rally, defensive stocks actually were heading lower. So healthcare in particular, I'm going to talk about that in a minute. Staples lower, energy went sideways. Utilities was another one that dropped significantly today, and materials is lower. So all the defensive sectors are lower. So that's really what you want to see if we're going to get a rally, or the rally is going to continue. So on the dashboard, you see the Dow barely moved, 0.01%, S&P 0.16. None of these really moved much today. NASDAQ 100 was actually the best performer of all of these, but still not much performance. You see the VIX there continuing to go down. Bonds, 20-year dropped a little bit today. 10-year dropped slightly today, 4.3%. So it's a little higher than that 4.25. So it actually was higher at the open and then continued to go down throughout the day. Commodities, gold moved higher and then pulled back a little bit and just went sideways. Silver had a nice day as well. Gasoline, all of these kind of just going sideways after a nice move up. And then crypto, of course, we saw Bitcoin, Ethereum actually below the open a little bit. So that's what they look like. So as I said on the sector summary over here, the two aggressive sectors, communication and discretionary, are at the top of the list. 2, 3, 4 of the most defensive areas are at the bottom. Utilities, healthcare had a big, huge downtrend today. Real estate went down. Staples went down. Materials just going sideways. Technology in the middle of the pack, but it moved up slightly today. If we look at the advancers and decliners, communication services, you can see the green ones. Energy was up, materials and technology. Real estate was the big loser, most decliners. But interestingly, discretionary, even though it was number 2 over here for all the sectors, it had a lot of decliners. So it's not showing a lot of strength in that move. We'll see what happens. And the industry groups down here, automobiles was number 2, renewable energies was number 4, gold and mining stocks were up there, internet here as well. You can look at automobiles and internet just out of curiosity to see what they did. So automobiles are here. Here's the stocks that moved them. for today, workhorse Tesla continuing to move higher. Nissan is up there, General Motors. This is just for today, remember. Rivian, Ford, starting to move up as well. So these are all the ones that are up for the day. And for the week, Tesla, number 3 for the week. Rivian is up there, up 10%. And we're only 2 days into the week. Well, actually, this includes last week too. So Tesla up 27% for the week. Ford up just 3% for the week. All right, the other one was the Internet Group. So here in Communication Services, here's the Internet Group. And interesting, Trump Media was number 1 for today, up almost 9% on the day. Next nav. So Netflix down here, up 2.6% for the day. And if we look at a 1 week view, Trivago up 20% for the week. Reddit up 13%. Reddit had started pulling back, so it looks like it might be recovering. So all these look like they might be starting to move higher. There's Pinterest up 10% for the week. All right, so that's what the sectors look like in the industry groups. Not too much over here on the top 10 combined list, other than this is a semiconductor stock right here. Go a couple down on the highest ones. Fortinet moving up. That one looked pretty good. Garmin moving up. The losers back here. We've got, let's see if there's anything of interest. BYDDY, it's a Chinese electric vehicle stock. AbbVie, healthcare. Look at that big red candle. Healthcare took a big hit today. Walmart continuing to head down as well. Ascendia Pharma took a big hit. Let's see if there's any other healthcare stocks in here. All right, let's go take a look at, before I jump into the Technical Tuesday, I want to show you the scan that I ran over here. Actually, I'm going to run the scan. And this time I ran the 5 crossing the 21 for a bullish view yesterday. Today I'm going to run the bearish view of the same thing. So these are optionable stocks. This is a scan looking for the 21 to cross, or actually the 5 crossing from the top to the bottom of the 21. So let's see what we have here. And as I suspected, we've got a few healthcare stocks. There's Amgen, big red candle over here. You can see the 5 is just getting ready to cross the 21. So it's already into the 2X area. By the way, I changed this a little bit. So what I added was how it's doing versus its peers is on the first panel. How it's doing versus the S&P is in the second panel. And then the third panel is how the sector is doing that it's in versus the S&P. So this is the weekly chart. You can see it got to the extreme up here, and now it's pulling back. And over here, we had a brief squeeze on the daily chart, and it looks like it's firing to the downside. Bristol Myers, another healthcare stock. Big red candle today, same thing, starting to move lower. GlaxoSmithKline, same thing, big red candle here, sitting right in the middle of its range, but definitely starting to head lower. J&J looks the same, big red candle. It's going to give a short-term downtrend tomorrow. It's got a squeeze. It's got a 5-day squeeze, so it's firing to the downside. So all of these healthcare stocks are moving lower. And then Micron that we talked about also continued to head lower today. So Micron continues to go back down to the bottom down here, where it continually goes to the bottom and bounces back to the top. Look at that 200-day, how much it respects that 200-day. Every time it gets there, it gets rejected and starts going lower. So you can see on the weekly over here how long that squeeze is on the weekly. That's a function of it just moving sideways, not getting out of that range at all, and just keeps bouncing around inside of that range. That's what creates the squeeze. So those are the ones on the bearish side. I can run the bullish complement to that, which is the 5 crossing the 21 on the upside. Right here, optional. They all have weekly options. So these are, you look at that, the NASDAQ 100 is on there. So that is I'll show you that in a minute, but that is an index, cash settled index option, which you get the benefit of a long-term capital gain. So 60% of the trade is long-term capital gain because it is a index, it is cash settled index option, regardless of how long you hold it. So if you could hold this for 1 day and still 60% of it is long-term capital gain. We've got Amazon. A lot of these were on the scan last night as well. Amazon, American Express. You can see that they continue to move up. So you can see last night is where a lot of these hit. So if we had done the short-term trade on those last night, they would have been in the money and probably looking good. Here's Google. Same thing. Google looks really good. Eli Lilly. So I'm going to talk about Lilly. Lilly's on the list. However, because it's still above the 21, but look at that big pullback. So this is one that I did a put, sold a put yesterday on, and I'll show you what happened with that today. Meta is on the list. Microsoft is on the list. Cloudflare is on the list. Nvidia is on here. So all the big names, big cap tech stocks are on here. Semiconductors moving up. So this is all very bullish. You know, these are all aggressive areas. Toll Brothers for those that are in real estate, just trying to move off the bottom. And then technology, which I talked about before, is on the list, just going above its 21-day. And consumer discretionary. All of these are aggressive areas. So it looks like the rally wants to continue. I do not have a lot of confidence the rally will get all the way back to the highs up here, but we'll continue to watch it and see what happens. It's going to be interesting to see. Go back over here to the website and go to the options page, and I'll show you what I mean by the cash settled index options. So down here on the options page, these are all the cash settled options. So these are all indexes. So you can't take possession of the stock because they don't have a stock. And over here explains that 60% of your profits being treated as long-term capital gains, regardless of how long you hold it. So right now they all have an early signal, a bullish early signal, and they are very close to getting a bullish short-term signal when the 5 crosses the 21. We can look at each one of these just by clicking on the chart over here. So there's the S&P. You can see how close the 5 is to crossing the 21. That will give it a short-term up signal. And you can see that on all of these. So if you did a 0-day to expiration option on these, 60% of your gain would be long-term capital gains. So it has a very positive tax treatment. So that's one reason to think about doing those. All right, let's look at Lilly and I'll show you what happened, what I did with Lilly today. So Lilly started off the day moving higher, but it couldn't hold. So it was a failed breakout. It couldn't hold and started to move lower pretty rapidly. And I didn't like not only the look of this as it moved lower, but also I noticed that the healthcare group, as a group, the whole sector, started selling off pretty aggressively in the morning after trying to make a new high. So I exited that trade. I did not wait until Friday. Now, as I said, on Friday, if it was above 840, then I would have 100% gain. But you can see the high of the day was 875 just about, and it came all the way back to 852. So more than 20 points in 1 day, and easily Lilly can move that much because it's an expensive stock. So if I had held it and it went below the 840, then I would own a Lilly at whatever 840 minus the, I think it was $3.50 was the option, was the premium, but I did not wait. I saw things moving down, and I saw a 35% profit, so I just took it. I just exited at market. I bought it back at market and made 35% gain on that. If I had held it, this would be at a loss for today, at least, because there are 3 more days left on the week. Now, each day that goes by and it stays above 840, the gains would continue to go up, which is what I would want. But there's no guarantee it'll stay above 840. It moved more than 23 points today, and it's only 12 points away from the 840 level. So I didn't want to take the risk. I just took the gain. Very short-term trade. But so these kind of trades, you have to watch them and be careful. But that's, again, with options. One person said, how do you do risk management with options? Risk management is not the same with options as it is with a stock. I went through risk management last Tuesday on Technical Tuesday for anybody that wants to watch that video. But I use a stock for that. What I typically do with options is I have a 50%. If it loses 50%, then I'm out. And usually between 70 and 100% on the upside is where I typically will take it. I usually don't wait all the way to the end for that 100% gain unless it's really moving higher, like Tesla. So look at Tesla. So there's Tesla. Tesla can continue to move. I had a 90% gain, exited that one yesterday, but it continued to go up today. So this gain would probably be at 95% or something. And frankly, it ended the day at 288. It likely is not going to come back down to 230. So this could have easily been 100%. But I'm happy with the 90%. So I exited that one. That was a one-day trade as well, just like today's was. But today was only 35%. So risk management with options are a little different. I would say just number one, where your buy point is the number one most important thing for risk management. Buying at the right time is the most important thing. So, and you need to understand technical analysis to be able to do that. So buy at the right time is the number one component of risk management. And number two is if it goes against you and it goes down 50%, then just get out. Take the 50% loss and get out. And you'll have plenty of opportunities to make 70 to 90% gains. So they will offset the 50% loss. But don't hang in there hoping that it's going to move the right way. Although Tesla did, but you can see what happened with Lilly, went the opposite direction. All right, so that's what I had to say about that one. If we go back to we did the positive side, the bullish side on this as well. So now let's do Technical Tuesday. Let's take a look at that. So to begin with, as always, I'm going to start with Investopedia and explain what covered calls are. It's a way to lower risk and potentially increase profits. Potentially, there's downsides to everything, so we'll talk about that. Covered calls an option strategy that involves an investor holding a long position in an underlying asset. So that's what makes it covered. It means you own the underlying asset. And then what you do is you sell a call option. So if we go back to the options page here, up here near the top, this little box right here explains the different types of options. So if you are a seller, then you have the obligation to buy or sell that particular stock. So if you are selling a call, that is a bearish strategy. So remember that sellers are different from buyers. If you're selling a call, it's bearish. If you're buying a call, it's bullish. If you are selling a put, like what I explained, what I did with Lilly and also with Tesla, I was selling a put, that is a bullish transaction. If you are buying a put, that is bearish. So right here is time decay. You have to always be aware of this. There's always a deadline on options. So if you are a buyer of the option, then time decay works against you. If you're the buyer, you want to have as much time as possible so that you can see time decay goes down very slowly in the beginning and very rapidly at the end. So this is the last 30 days right down here in this area. So as a buyer, you want to have plenty of time so the time decay doesn't hurt you too much. As a seller, however, it's the opposite. As a seller, you want to have more time decay because that actually helps you. As a seller, you want to keep the premium. Think of it like an insurance company. Insurance company sells you a policy. They charge you a premium. If your house does not burn down in the 1 year of your policy, then they keep the premium. That's their profit. So that's the same thing with selling an option. You are acting like the insurance company. You basically are hoping you just keep the premium, and the option expires worthless because time decay accelerates near the end. So you want to have a short time frame as a seller, a long time frame as a buyer. All right, so let's go back and take a look then at covered calls. So number one, we own the stock. Call option is a contract that gives the buyer the legal right, but not the obligation to buy the shares of the underlying stock. They can do it at any time on or before expiration. So sometimes people think that it has to wait till the expiration, but that's not true. They could buy the stock before that. Now, in most cases, there's no reason that they would do that if the stock is going down, because buying a call option is a bullish strategy. So they're hoping the stock will go up. But as the buyer, they have the obligation to buy the shares. As a seller, the seller of the call option owns the underlying security because they can deliver the instrument without buying. All right. So in this case, the covered call, you're a seller of the call. So covered call is most profitable if the stock rises to the strike price from the long stock position. Best time, this is important, best time to use a covered call. They can be an excellent tool for improving your returns, but they are best for specific market conditions. Number one, when the market is neutral or slightly bullish. So not much movement in the underlying stock or the stock that you own. The best time to do this is with a stock that you want to keep. In fact, you're okay keeping it even if it starts to move lower. In some cases, you might be stuck because it's moved lower. And this is a way to remediate your position, which is what I'm going to show you here in a minute. Number two is when you want to generate income from your existing holdings. So in this case, you have an existing holding, it might be going sideways. You can sell a covered call above where you think the price, above that range that the price is in. And if the call expires worthless, in other words, if it does not reach that strike price, then you keep the stock and you keep the premium. So you get to do both. So now you still have the stock, you got paid a premium, just like the insurance company, and you can do it again the next month. I'm going to show you an example of that with Nvidia. And then the third one is when you're willing to sell the stock at a target price. So it's a way to set up a selling point. So when it gets up to your strike price, then it gets called away, which means the person that bought that call option gets to take the stock. So you no longer will own it. The stock is now sold at that higher strike price. However, you still get the premium. So now you're actually selling the stock for more than what the strike price is because you add the premium on top of that. When to avoid using covered calls? When you expect significant upward movement in the stock price. So if that happens, then you will not participate. You will still make a profit. You will still keep the premium. That's why it's a safe option strategy in most cases. However, if it goes up a lot, you will not participate in that upside. You still will make a profit though. And when market volatility is high, you might think that that's good because it actually increases the premium that you can get, but it also means that the stock could drop quite a bit. So, which you might be okay with if you want to hold the stock for the long term, because you still keep the premium, you make the money on the premium, but the stock could go down quite a bit. All right, so here's an example of a covered call. Bullish scenario, XYZ shares, you buy them at $50. You could do this on the same day or you could wait, but in this case, on the same day, you sell the option for $4, so that's your premium. with an expiration of June, so 6 months later. And the strike price is $55. So you bought it for $50. You sold a call option for $4 with a strike price in June of $55. The stock closes at 60 by June. The option is exercised because it's above the 55, and you receive $55 for your share. Now remember, you bought them for 50, so you've got a $5 profit right there. However, you also get to keep that $4 premium. So you keep the $4 premium from the sale, and now you've made $9 total, or an 18% gain in basically 6 months. You no longer own the stock in that case, however. All right, the bearish scenario, same thing. You buy the shares at $50, call options $4, so you make a premium. By the way, you get that immediately, so that $4 is in your account. You need to have at least 100 shares, so every contract for an option is 100 shares. So to do this, you have to at least own 100 shares of that particular stock. If you want to do 2 contracts, you have to own 200 shares. If you only own 150 shares, then you can only do it for 100 of those. The other 50 shares will still be shares in your account, but 100 of those you can write a covered call for. But in this case, again, you've got a $4 premium with a strike price of 55. However, the stock closed at 40 now, below not only the strike price, but below the price you bought it for. So the option is not exercised. It expires worthless. You keep the $4 premium. The option buyer has no incentive to pay $55 for a stock that's now 40. That's why it expires worthless. Of course, they lose money too in that case. And in this case, the loss is $10 per share. However, you made $4 from the premium. So your loss is only $6 per share, or minus 12% in this case. So in one case, it went down $10 and you had a 12% loss. In the other case, it went up $10 and you had an 18% gain. So that's how it works. The other thing to understand about this one, even though that seems like you had a loss, but you still own the stock. So you still have the shares, you did make the premium. And if it's a stock that you're okay owning, even if it's going down, something like Nvidia, for instance, then you might be just fine with that. And you actually could do this again the next month, which I'm going to show you here in one second. So that's basically how covered calls work. You can go to Investopedia and look it up and read all this on your own. In fact, any option strategy has lots of information on the internet. There are lots of YouTube videos out there. That's usually why I don't talk about options that much, because there are so many educational videos on the internet. You can learn anything that you want to learn about different types of option strategies, and there are many, many option strategies out there. So let me show you one with Nvidia. So in this particular case, and I'll also show you how to use technical analysis for doing covered calls. So the first thing I'll mention, take a sip here. You can see Nvidia has been going sideways. So this is a perfect opportunity for a covered call. In general, it's best, if you understand technical analysis and you set your charts up correctly, it is best to do a covered call when the momentum, when the MACD is near the top. And why is that? Especially if you want to keep the stock. If you want to just generate income and hang on to the stock, you want to be selling the covered calls when it's starting to roll over, starting to go down, because the option will expire worthless. You will keep the premium and you will keep the stock. So in this scenario here, the example we're going to use is on 10/21. You notice Nvidia was going up. Now, the ideal place to buy it, if anyone that's been following me on my channel, you should know by now that the ideal place to buy it is down here when it closes above the 21-day moving average, coming up from the bottom. So that would have been the best place to buy it, to buy the stock, that is. But the best place to sell the covered call is when it's rolling over and starting to go back down. So in that case, it's when it goes back below the 21. But let's say you didn't follow those rules and you bought it up here, and then you notice it started to go down, and you thought, oh my God, why did I buy it there? but this is a way to remediate your trade. So now you're an owner of 100 shares at $140. Okay, so let's move this forward and see what we're going to do. In this case, we sell a covered call here. Now you notice that the momentum is starting to move lower. So this could be it. This could be the stock rolling over and starting to go down. But just in case, you buy the covered call for a 145. So for a higher price than what you paid for it. So what does that mean? Let's think about this. And I don't know what the premium would be. I can't go back in time and look at what the premiums were back at this point. So I'm just taking an imaginary $1. In this case, with Nvidia, it's probably higher than that. We'll look at that in a minute. But let's say we have a $1 premium. So if it does go to 145, that means, and you get called away, then you've made $5 there plus $1. So you're actually selling it basically for 146. So that's actually a profit. However, in this case, it did start to go higher. The expiration date is 11/15 for this. So 11/15 is right down here, right in this area. So that's the expiration. That's what you sold the call for. So if you want to hold on to it, you kind of are hoping that it's going to be below 145 by November 15th. Well, let's see what happened. Well, sure enough, it was. It closed at 142 on 11/15. So you keep the stock and you keep the $1 premium. And now your basis instead of 140 is 139 because you were paid the premium of $1. All right. So you're thinking, wow, that was pretty good. Maybe I'll try it again. Next time it drops below the 21, which is right there, you sell another covered call. In this case, your expiration is 12/20, so that's the next expiration in December. In this case, you make another imaginary $1 premium, and the strike price again is 145. So you're hoping it stays below 145, and you keep the stock and get paid the premium. Well, let's see what happened. In this case, it closed at 134. Now, you might be saying to yourself, well, I'm way underwater now. Yes, that's true. This is what I was saying. If the stock goes down, you will have to be willing to take the loss or willing to hold the stock. So in this case, it expired worthless. You made the $1, and now your new basis is 138. So the 139 minus the $1 premium. All right, and you still own Nvidia. Let's go to the next one. Say, okay, well, let's try it again the next month. You can do this every month if you want to. Well, the next time it went below the 21 day was right here. And you sold another call for $1. Again, strike price of 145. This time the expiration is January 17th. So we're moving 1 month forward. Let's see what happened on January 17th. Well, in this case, it closed at 137. So again, below the 145, so you keep the premium, and now your basis is 137 instead of the 140 that you started with. All right, so we're moving forward. The price went up after that. In this case, you own the stock. You're out of the option trade. You made the premium, and you're watching to see if it's going to continue to go up or if it's going to start to go down again. Well, if we look at the momentum, the MACD is struggling to stay above 1. So it's likely, and the trend is down, so it likely is going to fall lower. But look at this, it gaps down. So in this case, you might not want to jump in because it gaps so much lower. In this particular case, you would have to set you probably wouldn't make much premium, basically. So in that particular case, we're not going to take that particular one, but the next time it went below the 21 was over here. So we waited about a month and we did another covered call. In this case, our strike price is at 140 because this is continuing to move lower. So we can move our strike price from 145 to 140. And now our basis is 137, but now we're getting $3 because you get more premium if you're selling it closer to the strike price, if the strike price is closer to the actual price. So in this case, our premium is $3, strike price is 140, and looks like it's going to continue to go lower. And if we move forward, and sure enough, on 3/21, it was 117 was the close. So we've moved all the way down from 140 to 117. Now our basis is 134. So we made the premium all the way down, but we're still losing. We're losing on the stock. But you might be just fine with that, especially if you want to own Nvidia. This is a way to generate income while Nvidia is continuing to consolidate sideways, and now looks like it might be trying to make a run higher. You see now it's above the 21-day, so it might be starting to move higher. But now our basis is 134. So that's where we are at this point. So that's the way covered calls work. That's the way you can generate income. It might not look like it's a good move here, but if you actually want to keep Nvidia and hold on to it, and you're pretty sure, you're convinced with the company and its business model that it's going to go higher, then this is a way to do that and generate income and lower your basis each time you do it. So let's take a look at Nvidia again and look at it in a different way. Let's look at Nvidia. And in this case, so there's kind of the sideways movement. So let's say it's down here now, it's sitting at 120, and you decide now you want to do a covered call, but you don't want it to be a 1 month covered call. In this case, you want it to be a much longer period. So Stock Charts allows you to see the options screen. It's not completely accurate, so you probably want to use your trading platform to get the actual numbers, but at least it gives you a way to play around with some of the numbers and see what might happen. So we've got calls on the left and puts on the right. So remember, we are going to sell a call. But in this case, instead of selling it for 1 month out, which would be April, let's move all the way to September. All right, so now in September, we're looking at the monthly, September 19th. And so right now it's selling for 120. So we could sell the 140. 140 is where we bought it. Remember, our basis now is 134. So we could sell the 140. That's going to be a $6 gain just from the sale of the stock. But look at the premium we would get. Premium we get is $9.60. So if we sold this for September, we make $9.60 plus the $6 that we already have in here, because our basis is 134. So that's $15.60. We're essentially would be selling it for 155 by doing this. And that might be just fine. So you could sell this one for $960. You will get $960 in your account immediately. It's $960 times 100. And now you can just wait and see what it does. You can just hang on to the stock and wait and watch it go sideways, whatever it does between now and September. If it ends up being higher, then you end up selling it for 140. You could go further down. You could go to the 145 level. You still get $8.20. At 145, you could go to 150. You still get $7 plus the 6. So that would essentially be 163. So there's a way to do covered calls even much further out. And again, in this particular case, unless the stock just keeps going down and never comes back, then you're going to make a profit on this one way or the other. Either it never gets to 150 or it gets almost to 150, but not by expiration. And you keep the whole $15 and you keep the stock. And now you've got $7 off of your 134 basis. So you lowered your basis even more, now down to 127. So that's the way covered calls work. Hopefully that explained it, made it a little bit clear. They're the safest option strategy that you can do. And it gives you some experience in how to work with your trading platform and do options. Remember, this is a selling strategy, so you want to sell the call, not buy the call. All right, So that's it for today. Hopefully that was understandable. Let me know what you think in the comments section. I probably will not do any more with options because there's lots of ways to learn about it on the internet. You don't really need me, I don't think, to explain it. But somebody asked about covered calls, so I thought I would show how to do these. There's also something called a wheel strategy. You can Google that too. That's where you sell a covered call, and then if it doesn't execute, you keep the premium and you still own the stock. But if it does execute, then you sell the stock and you've got the premium, so you make double profit, and then you sell the put in order to get back into it later on at a lower price. And you just do that over and over again. You sell puts, you sell calls, and you just trade in and out of the stock, and it just continually moves higher if it's done correctly. But you can Google that too. You can see what the wheel strategy is all about. All right, thanks for watching tonight. We'll see what the rest of the week holds. We'll see if this rally can continue higher. It'd be nice for the rally to go up and we get a nice support level at the 200-day. That would be a great thing. Right now we're sitting on the S&P, just sitting right above it. But if we can get up here, 5850 is critical. We have to get through that. But if we can get above this level and then the 21 and the 200 start to act as support, even if it goes sideways for a while, that will be positive. Maybe we can get that rally. As I've mentioned in the past, I think we're going to get a rally and then a sell-off, and we're going to go lower this year, especially in May and into the summertime months. We'll see. Nobody knows for sure. No one knows what the market's going to do. All right. Thanks, everyone, for watching. I'll talk to you again tomorrow. And please like and subscribe and give me any comments or anything you'd like me to check out. Thanks.